JPMorgan has been fined $200 million. Pretty absurd what this is for. They were fined $125 million by the SEC. They were fined $75 million by the CFTC. So what exactly is it for? These regulators are claiming that there was widespread failures to preserve staff communications on personal mobile devices, messaging apps, and emails. More than 100 employees exchanged tens of thousands of messages via WhatsApp, text messages, and personal email accounts about business dealings from January 2018 until November of 2020. The lapses were institution-wide and known to senior management. Now, of course, we have a quote. This comes from Sanjay Wadhwa, is the Deputy Director of Enforcement at the SEC. It says JPMorgan's actions hindered several commission investigations and required the staff to take additional steps that should not have been necessary. Now, of course, when you go ahead and you look, what was JPMorgan's response here? Well, it's pretty simple. The JPMorgan securities team or division, they admitted that to the changes and to violating the securities law. They agreed to retain a compliance consultant and conduct a comprehensive review of its policies and procedures related to the retention of electronic communications found on personal devices. They've also agreed to implement improvements to compliance policies in addition to the fine. And then we also know that earlier this year, JPMorgan had its bankers install on their work phones a messaging and calling app called Movis, which records all of the calls. So trying to actually go ahead and document all of the electronic communication. We have a quote from Gary Gensler. It says, as technology changes, it's even more important that registrants ensure that their communications are appropriately recorded and are not conducted outside of official channels in order to avoid market oversight. Now, this is super, super interesting to me because one, everyone's going to run wild. They're going to be like, oh my God, they were fined $200 million. One, $200 million really isn't that big of a fine for a large bank like this, right? Yes, it is a big number, $200 million, but I don't think it's a big fine. The second thing is I actually think this is probably one of the hardest things for financial institutions to do. You have tens of thousands of employees. And if 100 out of tens of thousands of employees ends up using personal text messages, WhatsApp, email, etc., that can be a big problem. There's a lot of people when they see this, like, damn, you know what? I one time used my personal email for something, or I one time sent a text message, or one time I called, I didn't record the call, right? It happens. I think here what is really interesting is the regulators are saying, well, we were doing an investigation into something, and because these communications were not in the official channels, they weren't documented as they normally are, we were still able to access the information. It just made our job harder. It made us to go access it somewhere else. And so ultimately what I think is that people are going to dunk on this. They're going to go crazy. My guess is this happens at every single institution. It also happens in the technology sector as well. So this is probably one of the hardest things and doesn't excuse the behavior, right? It's wrong. They broke the rules. They should get punished. That's how it works. Every single bank probably has the same exact issue, and so do many other companies. One of the things that's going to be really interesting is as venture capital funds want to invest in crypto, they are all going, or many of them are registering as registered investment advisors, RIA. One of the things people don't understand is in a venture capital fund, historically, you have a 20% what's called a non-qualified investment threshold, NQI. That non-qualified investment threshold basically means you're making investments that aren't into the pure equity of a business. In order to continue to have the venture capital kind of label and to get certain exemptions and benefits of being a venture capital fund, you can't invest more than 20% of your fund in what is considered those NQI investments. Now, crypto and tokens and all that type of stuff falls in the NQI bucket. So if you have a fund and you want to go invest in crypto, if you want to put 20% or less of your fund into the crypto assets, then you can go ahead and be a venture capital fund. If you want to do more than 20% of the fund in it, you cannot use the venture capital structure, the label, and the benefits. Instead, you have to register as a registered investment advisor, and then you can go and put 100% of your fund into these types of assets. When you go ahead and you register as an RIA, there are certain regulations that you have to follow, certain rules. Things like documenting all of the electronic communication is one of those things. So you can see it's a big decision. People have to go through training. They have to get registered. They have to go ahead and they have to get all of their employees to meet certain testing requirements. They also have to install a ton of infrastructure. And so as we move from the legacy financial world into this new world, the tech industry has technically been operating as technologists, as corporations. They haven't really fallen under the ideas of some of this type of regulation. And so while it's easy to point and say, oh, the legacy folks, they're breaking the rules, my guess is that there's a big learning curve ahead for a lot of the technology organizations, venture capital funds, etc. So $200 million, big number, but I don't know if this is as big of a deal as people want to make it. What do you guys think?
They're calling each other, hitting each other. I'm trying to make some money. That's what I think they were doing. 100 people, that's all it takes. That's all you need. Trying to call people, tell them what trades are happening. So
But you think it's a big deal or you don't think it's a big deal?
I think it's a big deal. Yes. I don't think the money is a big deal.
Yeah, so you're basically like, hey, they should be following the rules, but the fine isn't a huge number.
Yeah, of course. I mean, 200 million sounds like a shit ton of money, right? But it's really not when you think of the size of their business. They've had fines that are bigger than this in the past for sure. So I think that it's a big idea that they should they shouldn't be doing this, right? And to be fair, there is difficulty in tracking some of this stuff. I know we mentioned that they created this app that basically you if you make a call, you have to register it and it gets recorded and all these things. To be determined, I think, if people are going to follow those rules. It's almost impossible to track to some degree, right? Whether you give someone a phone or you use their phone or whatever communication, right? Literally, you can meet someone in person and talk to them without it being recorded. So I think it's always going to be hard or difficult to track. But ultimately, I think these are the things that are difficult to do because these are the criticisms that Wall Street gets and these banks get is that people are doing shady stuff behind the scenes. They're doing things that are illegal, that shouldn't be allowed. And these things, whether you can prove that someone made money off of it or they didn't or gained some kind of advantage from a market perspective, it doesn't really matter in my opinion, right? They're not following the rules that are set out by the SEC. So if these rules are theirs, that they should be enforced. Hopefully some of the technology changes that JPMorgan has made will be helpful, but on kind of a headline number, 200 might grab some people's attention, 200 million, but ultimately it's not really that much money for the bank.